Welcome to Stockology. In this video, we are going to discuss different trailing stop loss methods for equity investment, short to medium term. When we say about equity investment, there are basically three types of equity investment: long term, medium term, and short term. Long term equity investments are those whose time horizon is more than 5 to 10 years. In this video, we are going to talk about the equity investment which are to be done for the short term, that is for some days to some weeks or extended up to some months, and how you will trail the stop loss. So that is what we are going to discuss in this video. Firstly, let us understand what is the difference between stop loss and trailing stop loss. In a simpler terms, let me define you. Stop loss is something if you are entering a stock and expecting that prices will go up, but that doesn't happen and prices start to decline, then you would like to exit taking some small loss. That is what is called as stop loss. But trailing stop loss is that if you are entering into stock and prices start to go up in your favor and you are in profit, but at that same time prices suddenly starts to correct, then you would like to book at least some profits and not go into loss. So that booking some profit, and the method is called as trailing stop loss. So basically trailing stop loss is designed to protect gains by enabling a trade to remain open and continue to profit as long as the price is moving in investors favor. So there are basically three methods that way you can set a trailing stop loss. First is profit percentage wise, another is price action wise, and indicator based. Let us see what is profit percentage wise. It is depending on different individual persons decide the minimum percentage you would like to book profit. So let me give you an example. Suppose you have bought a stock at particular price and prices are going up and you are in profit of let's say 10% in that stock, and then prices starts to correct, then you may set a trailing stop loss such that you would at least book 7% and not below that. So now this is just an example. In a way you are okay to lose that 3% and you are okay to take at least 7% in that particular investment or in that particular swing trade. So this percent can differ person to person. One is, if one can be okay with 5% or 10%, 8%, so that profit percentage you can allot for yourself. Another is price action based, and there are again two ways: Dow theory based and trend line breakdown. So let us go on to chart to understand what do I mean by Dow theory based trailing stop loss method. You all know that Dow theory, in the Dow theory, uptrend is defined by higher highs and higher lows. So right in front of me I have this ITC chart on a weekly time frame. So you will see that right after this particular bottom, prices are started to moving up, and then there is a higher high higher low formation up till now. Okay, so let's say, assume that you have bought stock somewhere over here, keeping the stop loss near below this swing. As the prices move up, what you can do is, once the price crosses the previous high, you can shift your stop loss to the previous higher low. That means if the initial stop loss was at 110 levels, now you can shift it to 140. Next is when the prices are again going up, when the prices broke the previous high, you can again shift your trailing stop loss at these levels. Then at these levels, likewise, you can find the previous higher lows and keep on shifting your trailing stop losses to be in the trade for the longer duration of the time. Another method is trend line breakdown method. For that, you need to use this trend line tool and find the previous swing low and mark a trend line up till the current high. Okay, now what you can do, simply clone this trend line and adjust it at the lows of the current price action, and now you have to wait until you see prices breaking down this trend line. So suppose in future if there is a bearish candle which is forming and it is breaking the trend line, that is the time you can consider booking your equity investments. So these are two methods which are based on the price action. Coming to our third method, that is indicator based. So I know three indicators. There may be some other indicators as well, but these are simpler one which I'm going to discuss in this video. First is using EMAs. EMAs is exponential moving average, another is super trend, and then you have Heikin-Ashi candle based. Coming on to one by one, so let me just hide this trend lines. Coming to the first indicator, that is EMA. So I have already plotted one EMA, which is EMA 9. So this is 9 period exponential moving average, and you can be in the trade. Suppose you have bought somewhere over here, so you can keep on monitoring the stock on weekly basis and be in a trade till the time it is running above this weekly 9 EMA. So suppose in this example, if you have bought over here, so you have the exit over here. So once the bearish candle closing below this weekly 9 EMA, that time you can consider booking your equity investment. Likewise, currently there is still no exit. If the prices in the future starts to trade below this 9 EMA, one can consider booking ITC from the portfolio. This is EMA 9. One can even use the 5 period EMA, that is a little shorter time period, but that will also give you a good result. So that is EMA based. There is another indicator which is known as super trend. So I have already plotted a super trend. Let me hide EMA and unhide super trend. So super trend is something you will see, that is a green and red line that follows the price action. The settings which work best are 14.1. So you can go into the settings to make the needful changes. Till the time the super trend line is green and your price is above it, one can be in the trade. You will also notice that this super trend green line acts as a support. So till the time prices are above it, you can safely be in a trade. Once the super trend turns red, or if the green line is broken by the red candle, one can book partially or completely from your positional swing trades. So that is all about super trend. And then there is another tool which is candlestick based. So now currently we are on to the normal candlestick. What you can do is go on to this candlestick and click on to Heikin-Ashi. So Heikin-Ashi is all green and red. So till the time your equity investments are green on a Heikin-Ashi candlestick pattern, one can be in a trade. If you notice some redness or some red candle which is getting formed on a Heikin-Ashi, you can book or you can set your trailing stop loss likewise. So this is all about indicator based. So we have seen the percentage wise, price action based, and the indicator based. Before we use the trailing stop losses, there is one more method that we can use to suspect price correction, and that is the concept which is known as bearish divergences. So you can use higher time frame bearish divergences that can help you in partial profit booking, that will act even before any of the above method will be in action. So if you see certain signs, you can consider partial booking and then wait for any of the other method which we discuss to allow you to operate the complete exit from your equity investments. So let us go ahead and check on this ITC chart itself. So bearish divergences can be seen on an indicator. So right now in front of me I have this CRSI, and you will notice prices are making higher highs on a weekly time frame, but at the same time indicator is making the lower high. That is called as bearish divergence. If you check this chart on a monthly time frame, you will see the same scenario. So on a monthly weekly time frame, you have ITC showing the bearish divergences. So that's a sign of caution. One can consider partial booking, wait for the price action to confirm, and then whenever prices will decline and you will in the future get the another chance to re-enter, one can re-enter again. So that is one sign of caution one can use before you use any of the above method. Coming on to end of this presentation, see why we are discussing about trailing stop loss is that booked profits are always better than a book profit. As an investor, when you see a good profits on your portfolio and when the prices suddenly starts to decline, it's painful for the investor to see loss in profit. So it is always better to have a system to prevent any seepage from your profits. That's it about the trailing stop loss method. I hope that was helpful to you. Do let me know in the comments how do you find this method, and if there are any other matter, feel free to discuss that in the comment section. Thank you so much.